Insurance broker, when looking at burning cost policies, is to be able to clearly explain to their employer exactly how the burning cost policy works.
More and more companies are taking out burning cost policies to cover their workers' comp liability due to the lure of lower premiums. But how do they work?
The benefits and risks of a burning cost policy is associated with the deposit you could pay, which is a lower premium, so that's the benefit, so you can pay a lower premium than a standard. But the downside is that you could pay higher than a standard premium depending on your claims experience and how high those claims costs are.
Many companies also don't realise that they can end up paying even after the policy's term has expired.
They can run for 3 to 4 years after the insured period. So why it's important for employers to understand that is that at any point in time, if you've got, for example, 3 or 4 years worth of burners running at once, you can have up to 7 or 8 years worth of open claims period where anything could happen on those claims during that time that may trigger a call up maybe even 3 years after the expiry of your policy term.
So how can brokers assess whether a burning cost policy is right for their clients?
For a burner to be appropriate, from GIO's experience, is that an employer needs to clearly understand their OH&S or WHS experience, the frequency of their claims, their average claim size, and what programs do they have in place around injury prevention and accident prevention, return to work programs to get people back to work sooner, as what that does is improves the average size of claims and reduces the number of claims that they might have, which can impact on a burning cost policy and perhaps trigger higher premium call-ups. It's really important that the brokers clearly explain that to their employers, so they need to be quite detailed in telling them the upside and the downside to them, that they could pay less, which is great, but they could potentially pay more than they would under a standard premium. So that's really important that they explain that. The other thing is also, again, around the long tail of burning cost policies, is that they can run for 3 or 4 years past expiry of the term, and we have seen, or GIO have seen, examples where that's not properly explained to employers. They get quite surprised when 3 years later the insurer is actually asking for more premium.